Hey everyone, welcome to the Real Estate War Room live. We are here today with Brian Heller of Fairway Equities, and we've got a great show for you guys today. So, our guest, Brian Heller, today is a true industry powerhouse with over $300 million in real estate transactions. As a driving force behind Brian Heller Real Estate Investment Strategy, he simplifies real estate investing. His team excels in acquiring, repositioning, and optimizing properties while pioneering cutting-edge residential and commercial communities. Previously, as a director of asset management at OfferPad, Brian launched the Nashville market, growing up the portfolio to 330 properties in just 1.5 years. And his strategic approach achieved an average push rate over underwritten ARV by $15,000 with a remarkable 14-day on-market to contract. Brian outperformed ROI expectations at OfferPad, delivering 7% compared to the underwritten 2.3%, completing transactions in just 85 days, time till cash. Prior to that, in his role as VP of Multifamily Sales at Sperry Van Ness, Brian closed $150 million in multifamily, retail, industrial, single-family residential, and condo transactions, selling 769 apartments at an average price of $3.5 million, completing 7 transactions annually. Beyond his professional success, Brian is a USC graduate, lives in Nashville with his wife and daughter, enjoying a little bit of golf, classic rock, traveling the world. Get ready for some insights from a true industry expert, and welcome, Brian. Appreciate you joining us on the show today.
Yeah, thanks for having me, Ryan. This is great.
Definitely. Well, we've got a lot of stuff to talk about, and we've got a lot of things that I think people want to know about. You know, there's a lot of turmoil in the market and in the industry, and there's potential recession looming, and there's a lot of things that have investors either fearful or just uncertain about what's going to happen next. So I like the topic that we're going to cover today is, hey, what's going on out there and what happened in the past that's very similar, and then what might be different. But before we get into all that, tell the people a little bit more kind of, about your background, the things I just mentioned, but, kind of brag a little bit on yourself. Tell us, like, what are some of the highlights? What are you working on? What's exciting?
Yeah, absolutely. So I grew up in California, born and raised, ultimately went to USC and was a cinema graduate there, #1 film school in the country, and worked on shows like Survivor and The Bachelor. You can see back here, I've got a real Survivor torch from my days producing challenges and living in China for 3 months and Palau for 3 months and blown up mountains, all sorts of cool stuff in my television days, but ultimately decided to get into real estate in 2010, which was somewhat of rock bottom of the last cycle. And obviously we're going to dig into that a little bit deeper, but was an apartment broker out there, specializing in, under 100 unit properties, because in Los Angeles, 100 plus units gets into some pretty high dollar value institutional class real estate, but was also an on-site manager for one of my clients for 6 years. That was a great opportunity to really see the ins and outs of a building and watch as they went through the entire value add approach. And this building was right off the Sunset Strip. So, really key area there in West Hollywood, and really great learning experience. But ultimately I decided I wanted to get more onto the principal side of things, and the Los Angeles market was pretty expensive. So decided to move to Nashville a little over 7 years ago now. Since I've been here, I've done everything from building houses to entitling land that we ultimately sold to one of the 7 largest home builders in America. And as you mentioned, I was an asset manager for one of the big national iBuyers, but I'm also gone full cycle on an apartment syndication out here that my partners and I purchased in 2019 and ultimately sold in June of 2022. Basically, we completed our 10-year business plan in 2.5 years, well exceeded all of our expectations, and decided it was best to sell the asset and get our investors incredible returns of 40 IRR and a 2.43x. So everyone in that endeavor is very happy. And the great part is we had the perfect timing on the sell. The hard part's been replacing it and finding more opportunities, especially here in Nashville, where we've been voted ULI's #1 market in the world for 3 straight years, which is a blessing and a curse, because now everyone wants to buy here. It's no longer the darling secret. It's the it city. But working through that, using great broker relationships, and obviously continuing to source opportunities here and looking at other high growth markets across the US. But at this point in time, I'm a full-time apartment syndicator and capital raiser. Currently, any day now should have a deal, 60 units under contract in Kansas City with one of my strategic partners in one of the high growth markets that I mentioned. So, that's a little bit about me. I'm married and got a 6-year-old daughter, and love to play golf, and love football, and big foodie, and love to travel. So my teams did not do too well this year, but onwards and upwards is the only place they can go.
Living the dream. So I'm curious, you've been both on the broker side selling buildings, from houses all the way up to, multi unit, transactions in Los Angeles, which was like one of the hottest markets in the United States. So kind of tell me, what was it like working there and doing these deals, and like who are the people that are buying these deals in LA that are paying this much money for apartments?
Well, yeah. So, I mean, again, I really wasn't dabbling too much in the institutional space, your brand new Class A's. I dealt with some developers that would develop new Class A, but even then I sold a couple of sites, whether they were tearing down old buildings or maybe tearing down a duplex and a retail store and then putting up, 40 units or something like that. But no, I mean, look, very competitive marketplace, lots of brokers. Still very similar though. I mean, most of the people I was working with were looking for value add B and C class properties in up and coming sub markets. Call it 10 to 100 units, and strong fundamentals and value add opportunities.
Yeah, yeah. So, I mean, is it like, would you deal with kind of mom and pop owners or other syndication groups, or who were some of the typical people you would be working with as on the brokerage side?
Yeah, mostly mom and pop individual investors. But even then, a lot of them were syndicating. Like it'd be a doctor, and he'd bring in a couple of it. Maybe it'd be a JV more than a syndication.
Mhm.
But yeah, and then several syndicators. For sure,
Gotcha.
that was my main groups of people that I worked with.
Gotcha. And so you moved out of Los Angeles and the commercial brokerage market, and now you decided to join the owner principal side. Kind of tell me what's the thought process between, making good money doing these transactions and getting paid a good commission towards taking on the risk, being on the ownership side. Why the switch? Kind of what's the mentality there?
Yeah, well, I mean, the simple answer is partly you get tired. I mean, the $100,000 commission checks are great, but you saw that you made, or helped your client create a business plan that made, $1 million. Now, obviously, they maybe have to split it up and whatnot, but there's just a lot more, I think, opportunity on the principal, not only monetarily, but also in terms of just creating long-term wealth and a strategic portfolio and creating way more tax benefits and things for yourself, than you can just on the brokerage side of things. And so it's just once you've watched other people do it, I mean, I think you can talk to a lot of brokers that get tired. Brokerage high highs and low lows and ups and downs, and not that operations and ownership isn't the same, but it's a lot more steady and stable and comfortable once you, I think, really get things going in terms of having a strong portfolio, having a great team in place, having markets that backwards and forwards.
Yeah, I mean, I agree with you. I came from the mortgage loan officer side, and we'd have good months, and we make a lot of commission dollars. But at that next month, we had to go off and find new clients and find new deals, and we had a few repeat clients. But yeah, it was a hustle, it was a grind. So I understand where you're coming from. When you were doing the brokerage, were you also investing in real estate at the same time, or dabbling on both sides?
I would have loved to. I mean, Los Angeles was just too expensive of a market. I mean, you're talking about a place where duplexes, even 15 years ago, were $700,000-800,000. I mean, I sold my buddy's fourplex, I think, for over $2 million. It went, at one point in time. So I mean, it's just the amount of capital required is pretty restrictive on deals
Hmm.
out there. So no, I mean, I didn't own any real estate in California, but now here in Tennessee, I got a duplex, I got a single family house that I rent out, I've got the house I live in, and I've had the apartment building, and so been able to vastly grow my real estate portfolio in a short amount of time, and hope to be adding another 100 or so units this year, if not more.
Gotcha. Man, great goals to have. So I'm curious. So on the ownership side, you are both a general partner and a limited partner in some deals. So kind of tell me what's the mental space you're in each of those areas.
Yeah, well, so it's interesting you bring that up. So I actually was an LP for the first time in a deal this last year in 2023, and it's actually a deal in Denver with some friends of mine, and what's crazy, it's a no brainer deal. It's a trophy property, um, 40 units in a great high growth market. I knew the operators and the sponsors very well, and they got 2% seller financing, which is like unheard of. I mean, that's really what the icing on the cake. It's a historic trophy property in one of near Cheeseman Park, which is one of the premier parts of town, and so great opportunity. But like I said, I'd never been an LP, and I'd never given my money over to someone else and been a part of someone else's deal. And it was a really great learning opportunity for me as someone who raises capital to see how difficult it could be, and the emotions that you go through um, in the process. And I even like challenging yourself: is this the good deal? Is this the best place to put my money? Are these returns acceptable? What's best case scenario? What's worst case scenario? But in the end, now I'm sitting here 6 months later, I'm like, damn, I should have invested more. And so it's like, it's a process, but I'm also really glad that I went through it, because I think it will help me to better service my clients, and really understand what they're going through, and recognize that it is a difficult process, and that everyone's going through different things at different times, and to be cognizant of that. But it in the end of the day, also knowing that it's a rewarding experience, and does build wealth, and improve people's lives long term, I think. So in terms of the GP side, that's really, it's really rewarding as well, just to be able to take I really enjoy taking projects from what I say is from concept to completion. And so with our first building that we did, it was 24 units out in Gallatin, real great unit mix, but the owner was someone that his family owned a ton of real estate in the town, and he's very fortunate, and I think they just he's been collecting checks on this building for years, and was crushing it. But we were able to come in, and not a lot of the units had been rehabbed. It needed a new roof. We took the working class brick look and painted it white, and with a black roof and black lights, and really created that crisp, clean look that so many people are doing right now. But it just absolutely changed the trajectory of the property, and we're able to really push rents. And we had the challenge of taking the property through COVID, and literally we had no problems with distributions, no problems with any of the tenants. We were able to work with, I think, one tenant we had to put onto a payment plan. But other than that, it's just a lot of fun, like I said, to really execute on a business plan, and communicate with your investors, and create opportunities for them that improve their lives, and their financial portfolios.
Yeah, absolutely. So I'm curious to hear a little more, like when you came into this, you said, because you've been in real estate, your whole career here, and you had some hesitation and emotion about being an LP on a deal, and giving up some control. And you know the business, you know it better than most LPs do. So kind of I'm curious the headspace that you're in about giving up control on something that is such a good deal. And what are most LPs supposed to think or go through that process without all the knowledge that you have?
I mean, I think it's just like anything. You got to educate yourself. You got to research yourself. I mean, again, for me, it was a market that I hadn't necessarily been to, but I got lucky and I actually got to go and visit the property right after we closed due to some travel that I just happened to have. But no, but I mean, I guess I think it's about overcoming the myths, that we've all been taught. You invest in your 401k or you invest in the stock market, and that's everything. But every day, I feel like the stock market becomes more like a casino, and the opportunity to invest in hard assets that have cash flow, have appreciation, where you're forcing appreciation through value add initiatives, where you're getting tax benefits. It's I think the other day, I mean, someone was telling me that if you had bought stocks before COVID, right now you'd be up, between the ups and the downs of after COVID and everything, you'd be up 6%. Well, anyone that bought an apartment building after COVID is up like 600%. So there's your answer, right? So well, I think we all.
Yeah. So I'm curious, because a lot of the people that watch these kind of things, are considering being limited partners. They might already be, or they might be just curious about getting into it. So if you were to, decide, hey, I want to be a limited partner in the deal that you were in versus all the other deals, what's the thought process that you go through on choosing who you trust as a sponsor, how you evaluate a deal? I mean, it's one thing to say, yeah, do your due diligence. What are the actual steps you're taking when you choose, is this a good investment for me or not?
Yeah, I mean, obviously you always want to underwrite the operator. So like I said, in this case, the operator actually, so this is an older building. That was a concern of mine. This gentleman has purchased a ton of older properties in Los Angeles that I actually happen to know several of the properties from his portfolio from my time in Los Angeles. His one of the lead people at his company and the guy asset managing it are two people that I know from a high level mastermind group that I'm in. The 2% seller financing was a no-brainer, right? The reason why so many deals weren't penciling last year is because people were at 8%. If you can change the debt to 2%, I mean, our debt service compared to the income is absurd. Again, a great high growth market at a good price per unit hit all the metrics that I was looking for. The sponsors weren't overfeeing the deal. They were only taking an acquisition fee and I think a disposition fee and an asset management fee, but not like some of these groups that take a fee to literally write their name down. And so I just think things like that. I mean, it checked all the boxes. Good unit mix, good value add opportunities. The only thing I would say it didn't have that is parking. And I addressed that with the sponsors, and I mean, it has some, but it's not a fully parked building. And in Los Angeles, that's a really huge deal. And in Denver, it sounds like it's not quite as big of a problem. There's plenty of street parking. And they told me, they're like, every time I've been to the property, we found a spot in 2 seconds. And literally the one time I went there, we found a spot in 2 seconds. So I don't know, can't argue. So,
fair enough.
I mean, I'm sure in the cold of winter, and if it snows, I mean, God only knows, but then I guess hopefully you had a spot 3 days ago and you don't leave.
Yeah, I gotcha. So let me ask, I mean, because you've been doing real estate, longer than most, have you seen any transactions that have gone bad? People have lost money. This is the real estate war room. So we want to know transparency behind the scenes. What are some of the difficulties that you've seen on the investing side of real estate?
Gosh, I'm actually pretty lucky. I would say that most of the syndicators I've worked with, the mentors I've had, the deals I've been a part of have all been pretty successful. Obviously, like I said, I started at rock bottom of the longest and most successful real estate cycle. I mean, certainly, obviously, what you're seeing right now with everyone and the floating rate debt, overpaying for properties. I don't know anyone personally that I've heard stories of plenty of other people getting into deals, and people in some of these mastermind groups that I'm in having challenges. But yeah, I mean, I guess if you I wouldn't even call this a horror story. I had a deal that I had put under contract literally last day of February before COVID started. And so I had it under contract. We couldn't do any of our inspections, right? Because you couldn't go into units. I mean, the whole world shut down. And ultimately, I wasn't able to purchase the property because there were several issues that I had discovered that I felt were problematic to the property, such as the roof, that it was a flat roof and it was like a $250,000 quote, and the back of the property was flooding, and there was a crack in one of the sides. And so I got quotes on all this, and I asked for it and I couldn't get it. And it was a difficult capital raising environment. Obviously, I mean, I was able to extend and extend and extend, but it got to a point where the market still hadn't quite picked up, and I had already had it under contract for like 6, 7, 8 months. And I ultimately just decided it was too risky. You know, no one knew the market was going to explode like it did. And in hindsight, that building has now been traded twice, and each person has made over $1 million.
Wow. Wow.
So
I mean, it shows the power of real estate.
I should have just bought the damn thing and not worried about the roof and all that stuff. But you know, when you got investors and everyone everyone still thinks the world is ending, you want to dot your I's and cross your T's. And I don't think you can really ever go wrong doing that. But somehow in this case, I guess you could argue that I did. But you know, life isn't all about money either. So,
well, and how many of the deals that you did proper due diligence, cross your eyes, and avoided a big mistake that someone else took on? And you know, you just it's like you said, you got to weigh which risk are you comfortable with, which risk are you not? You know, and that's kind of all of this investing is just weighing risks and picking good opportunities and placing your bets where you have, you know, nothing's guaranteed, but just, you know, I have a lot of confidence in what we're getting into here. So I think that's a good transition into our main topic that I want to talk about here is, you know, the market in general. I mean, we're seeing banks tightening up their regulations, and we're seeing a lot of changes, you know, even right now moving forward. It seems like month to month, you know, things with interest rates in the market and interest from sellers and buyers is changing quite a bit. So tell me, I mean, the topic here, you know, this reminds you a lot of 2010. So kind of tell me what was going on in 2010, what's going now, what are some of the similarities, and what are some of the differences in what we're seeing in the market as a whole?
yeah, absolutely. So, you know, look, market environment, right? You know, there were at that time, you know, the recession in 2010, the recession had already been going on for a little bit, but you know, right now, recession alarm bells, lots of pressure on the Federal Reserve to lower rates, general uncertainty about when things might potentially stabilize, low transaction velocity, lots of people leaving the real estate industry. You know, I was a new agent, you know, and no one was hitting the phone. So for me, that was advantageous. But, you know, a good little story. There were 6 of us that started at my brokerage on the same day. And I'm the only one that ever made it to selling their first deal, which I actually did almost a year to the day from when I started. But you know, it was there was difficulty getting financing. It was much tougher in 2010 than it is now. You can get financing, you just might not love all the terms and the rates. Then it was actually almost impossible to even get financing. You know, creative financing to get deals done. I remember one of the first properties that I put under contract, it didn't go. We were trying to do a wraparound mortgage, and it just never, you know, worked out. But you know, most buyers are on the sidelines, a lot of pencils down environments, a lot of wait and see and herd mentality going on. Bid ask spread was still wide. You know, buyers and sellers were struggling to truly find the values to transact. And, you know, probably if you ask most people, they would have said it was about 6 to 18 months before the market, you know, would truly get back to normal. And you know, truthfully, that is about what happened. And, you know, I think to some degree, that's what's going to happen now. But let's go to the other side of the coin, you know, playing Monday morning quarterback, you know, in hindsight, many positives came out of that time period, again, for someone starting in the industry as well. But, you know, it's clearly now the birth of the new cycle, looking back, you know, not only the birth of a cycle, but the strongest and longest cycle in real estate history. Those who did buy deals earlier in the cycle, you know, were very happy over the next 5, 7, 10 years. You know, it sounds crazy to think that, you know, in Los Angeles, these are, you know, there's a lot of like 1900s, 1920s buildings that are mostly singles, which is a unit type. that are smaller, but you could have gotten those for $50,000 a door, and now they're probably trading for $250,000 a door.
Mm-hmm.
And you could have bought properties in Los Angeles, at a 6 cap at the peak of this market, and that's B and C value add. I mean, 6 to even 7 cap. And
Mm-hmm.
now there was a time in the market where Los Angeles was probably two caps in Santa Monica, 3 caps in Koreatown, kind of a thing, and absurd, right? I mean, that amount of cap rate compression, you can only imagine how much value it gets unlocked. And obviously, same thing. Interest rates came down. The Fed kept pushing interest rates down, and the rest is history. So that's a lot of the correlations and stuff that I see, and why I feel like things are so similar. And I'm not telling you to go buy everything you possibly can right now. I mean, to some degree I am, but you still got to be smart. You still got to check your buy box. You got to buy right. You got to finance it right. And you got to, have the right property in front of it. You got to buy on actuals. You can't buy on pro forma. But if you're paying, you can't expect to flip it in 2 years and get paid. But if you go with the standard 5 to 7 year timeline, and you have strong acquisition criteria, and you have a strong value add business plan, I think you're going to do fantastic. And not only for yourself, for your investors, for everyone.
Well, yeah. And I mean, real estate market cycles are typically 7 years. I mean, we had, pretty much 11, 12 year run this last, but yeah, if you wait 7 years, you buy right now, you'll be at the top of the next market cycle. Perfect time to sell. So I'd agree with you there. So I'm curious your opinion on, back in 2010, who were the people that were involved in the market that made the right decisions that came out okay? And who are the people that, were in real estate in 2010 that lost out, that did the wrong choice, and then kind of move forward to today? Who are the people that are going to be successful if they're making these moves? And who are the people that are going to dig themselves into a deep hole if they're making some mistakes out there right now?
I mean, I think it just goes back to, like I said, sticking to your guns and really being firm in your buy box and what you're looking for, and sticking to it. Don't chase. Don't do a deal to do a deal.
So to elaborate more on that, when you say don't do a deal to do a deal, like what would be a deal that you wouldn't normally want to do?
Well, I mean, some people are trying to do more deals just to obviously get fees and stuff for themselves, and not necessarily looking at the true fundamentals, or are writing in too much rent growth, not anticipating the absorption issues, picking exit cap rates that are wildly too low. I think so. Another thing that I think reminds me of, so we're getting sort of this market reset, right? Going to psych in 2010, you were coming off this period of euphoria where everyone's making money in real estate and kind of getting back to normal, right? Well, normal, and I think why we're having so much transaction problems right now, and why everyone's struggling to find valuations. I mean, normal historical interest rates are 6%, right? So that means that everything has to get back to at least a 6 cap, if not higher, in order to not be negative levered in deals. So if you want to know the number one thing not to do, don't negative lever a deal, and don't anticipate that when interest rates are going to get to where you need them, because you might never get there. And I mean, that's a mistake I see a lot of people making, and that have made in the last year. And again, they might have the appetite for it, and they might have the plan, and it very well might work out. But that's like a number one rule for me: don't negative lever a deal.
And when you say negative lever a deal, you mean don't buy a 5% cap rate deal if you're getting an interest rate at 6%. If it's a stabilized deal, there's nothing to add value to it, because you're going to be losing that difference between, you're going to lose that 1% difference between 5 and 6% every year.
Well, and even if you're trying to add value, I mean, you still you got to be really careful, right? Because you also can't write in 5, 10, 20% rent growth, right? I mean, if you got to be writing in, I mean, I'm underwriting everything right now with like 0% rent growth, at least the first year, and maybe 3% after that. But I mean, that's Nashville, that truthfully, I think will be higher, but to be realistic, yeah, I think that, that's where you want to be.
Well, I'll tell you, even here in Austin, I mean, from about 2012 all the way up until last year, we saw about 5% rent growth average annually, and then in 2021, there was like a 20% rent growth spike in some neighborhoods in Austin. It was huge. But then, this year I've seen, maybe a 0 or a -1 or 2% on the rent growth, here in Austin. I do, we typically try to pencil in, hey, 3% rent growth moving forward, but that's what we're doing. I'm taking about 2 years of 0%. We'll bring it up to where comparables are. So if somebody's got 1,000 of current average rent, but I see across the street they're already hitting 90% occupancy at 1,200, well, we'll take it up to 1,200, but we're just going to keep it right there for 2 years, and then year 3 we're going to start adding that 3%. But I agree with you, right? So tell me a little bit more about some of these numbers, because it's easy to say, hey, do your due diligence. Like, what are, at least in, Tennessee there, what are some of the cap rates that you think people should be underwriting as exit cap rates on some of these deals, or going in cap rates?
What should they be, or what are they?
Well, yeah, 2 different questions. The people that are going to be successful, who are those people? Yeah.
Here I'll say this, but this may not be answering your question, but it's a conversation that I have with people a lot of times. So, there's so many more people that are in this apartment syndication value add game that when I started in 2010, it was kind of a niche thing, right? But now with all the gurus and mentorships and bigger pockets and everything, there's so much more competition. And so what used to, I was in 2010, I don't have this, actually maybe 100% correct, but if LA was a 6 cap market, that means Nashville was probably an 8 or a 9 cap market, right? And your middle of nowhere Alabama was a 12 cap market, right? And everything's, I think now with all this competition, is going to kind of come down one. So if LA was a 6 cap, now it's going to historically be like a 5 cap, and if Nashville was an 8 cap, it's maybe, even in Nashville's taken such a big jump, it's maybe like a 6 cap, right? But bottom line is, no matter what, anything really, like I said, it goes back to, it has to be above interest rate. So again, historically they've been 6%. I do think that as a result of this last cycle and just the world these days, I do think that moving forward, interest rates will fall below the historical norm, not back to 3 and 4%, but I do think maybe we end up settling in the low 5s, which would mean that, again, some of the Los Angeles's, Chicago, Miami, New Yorks of the world could maybe still be in that mid 5 cap range. But that still puts your Nashvilles, your Dallases, your Houstons, your Denvers of the world, at a 6 cap ish. And, these more rural markets, should still be at a 8, 9, 10, depending on how low down the scale you're going. I don't really dabble too much in those types of markets, but certainly, you want to get paid, for your risk reward return level. So again, I don't know if that answered your question perfectly, but I hope that was some interesting insight. That's my food for thought of the day, and I'm sticking to it.
I love it. Yeah. Transparency and numbers, any kind of data and information we can put out there and say, hey, look, here's what we're really doing on a day-to-day. That's what it's all about, is just sharing information. So I'm curious your opinion, like we've seen the rise of bigger pockets and coaching platforms and a lot of new people getting into real estate investing, becoming syndicators. What's your opinion on that? Do you feel like it's getting a little crowded? Do you feel like it's getting competitive? Is that the reason we're seeing cap rates compress so much? Are people, what's going on there?
Too many people are chasing deals and are too excited to get into the game and don't truly understand, I think, all the risks they're taking. I see and I talk to people all the time in these courses and things, and they've just gotten started and they got to get a deal and they got to get into it, or they'll send me over their numbers, and I'm like, well, in my head, I'm going like, how did these guys just started? How did they get a deal to pencil? And then I see, like I said, like it's middle of nowhere, Arkansas, and they've got a 4.25 exit cap rate. Well, yeah. anyone can make a deal pencil with a 4.25 exit cap rate, but I'm positive you're not getting that. So
Yeah,
what does
taking
that
it from
mean?
1 to 2
You
million with no value add. Yeah.
what does that mean is you're putting a lot of people at risk. So yeah, it's just, yes, that you have to be really careful. There's a lot of people out there, and I'm a really good judge of character and people. It's something that I actually learned in my television days, and going into people's houses and turn them into a television star in 10 minutes because I had to shoot 2 segments a day. Um, but yeah, I mean, you want to find people that know what they're doing, or that have a good team, because even just one bad team member, I mean, the number you asked me, I think earlier, like some of the risks or some of the war stories about in LA, I can't tell you how many times, there were families of certain ethnicities that did deals, and then ultimately, like, by the end of it all, none of them could get along. They were all infighting, and then they had to sell the property, and they all hated each other.
Yeah,
So
I agree. Choosing partners is very important. Choose wisely.
so yeah, I mean, you got to be careful too, because I see some people that they might know one good thing, but they bring in one team member, and it can throw everything off. So it's really about the full package, and you certainly want, you got to have good boots on the ground, and boots on the ground, asset management are probably the most important aspects, and obviously finding the deal, and getting it at the right price. But yeah, so that'd be my big advice to people is, my but if you want to talk about how far it's gone, it's funny. My friend was talking with me today, and he mentioned that there are now gurus out there basically telling people to go and get a hard money loan to then pay for their course. If anyone tells you to do that, run. I mean, that's how we're at the end of a cycle again, and people are getting crazy, and people are just out of ideas, and just trying to come up with the next latest and greatest. And I just started doing social media recently because to this mastermind, that's where a lot of the communication goes. But it's amazing to me how many people try and like run everything off of that, and they're like, yeah, I'm gonna do a deal that I found off of Facebook. It's like, no, you're not. Or I found a 1031 buyer, and they were going to do this and we're going to do that, and it's like, no, that's what you have is nothing. But you learn that from being in brokerage and hearing these things. And if you're new to real estate and you haven't heard some of these sayings, it sounds exciting and sexy, and it sounds promising. But I mean, to me, the worst thing anyone can ever tell you is, yeah, I'll sell that to you as soon as I find my 1031 exchange. That means you're never selling it. Or I could come up with 10 other phrases like that, or let me talk to my accountant. Yeah, I don't want to hear that. It's like like I said, or find me a replacement property first, and then I'll that has the same return metrics as mine. Well, it's not. For the first few years, your cost basis and everything is so low. I can't possibly, how long did it take you to get to where you are? Like, what I can do is get you from 10 units to go into 20 units or 30 units, but I can't get you, or I might be able to get you from a B area of town to an A area of town, but I can't you can't sell your 6 cap and go and just go and get the exact same thing with the exact same cash flow. It's just never going to happen. And so,
yeah,
again,
I hear you made an interesting point about the importance of operations, boots on the ground, asset management, and that's going to play a big role in the economy that we're moving into. So I'd love to hear you elaborate a little bit more on that. What is effective operations? How do you spot that in one team versus another?
Well, I mean, I would start with seeing who their management is, because I mean, really, asset management to some degree is managing the managers, but I mean, it's everything. I mean, you want to know that they have a good loan, because I mean, if you don't have a good loan, and what is your plan? Is this short-term debt? Is it long-term debt? How much value do you have to create to be able to get to that next loan? Because I think a lot of people miss the mark there, right? They they just assume everything's going to happen. And it's great to write it all on paper, but I can tell you from having done it, it doesn't, when you actually get into it, it doesn't look anything like it was on paper. Like I said, like we closed on this building and 6 months later, there's COVID. You don't write COVID into your underwriting and your operations, but you take a pause and you figure out like, okay, look, we don't want to be kicking people out. We can't turn the units as fast as we want, but hey, what if we can get all of the tenants to stay and stay at $50 less than what our market rent was going to be? Then it's still a win for everybody. And honestly, like, so we plan to renovate all 24 units and we only got to 14 of them, and we still crushed the value of the building because of cap rate compression. Is we got so many people to stay, but get really close to market rents anyways, because no one could go anywhere. So it's about, you got to be able to adapt. You got to be able to, read the room, read the market, see what's going on, and figure out what's going to be best. And you don't have to, you don't have to die on the hill of staying exactly with your business plan, especially if something else is working, or you can adapt. But if you have the right people in place and you can bounce your ideas off of each other and talk it through, and if they have 5,000 other units in the market and you can talk to them, and again, if you're tracking your numbers and you're hitting them, then there's more than one ways to skin the cat.
Mm-hmm. Yeah, I would agree. I mean, multifamily is not complicated, right? It's a place for people to live, but at the same time, if things are not going well, it takes rolling up your sleeves, getting your hands dirty, and moving quickly to do things that just need to get done. So, I hear you there. Well, before we wrap up, I'm curious. What's your plan of action personally for what you're going to be doing this year and next year? Where do you see opportunity? What are you going to be doing to maximize value?
Yeah, well, so first thing I'm working on right now is I'm in a rebrand. So for years I've been Brian Heller Real Estate Investment Strategy, and you kind of alluded to it in your intro because I hadn't told you that I'm in the middle of a rebrand. But any day now, I actually just shot some videos and stuff, some content and stuff in Charlotte for my website. But rebranding to Fairway Equities, which is going to be a full-time apartment syndication and capital raising company. I'm aggressively looking not only for my own properties here within 4 hours of Nashville, but in other high growth markets across the U.S. with strategic operators that have strong track records and, like I said, are in markets and whose approaches align with my buy box and acquisition criteria and core values. And the hope is to add 100 or more units this year on the GP side, ideally with a majority coming in deals that are mine, and potentially also doing some capital raising, like I said, for some of these strategic partners as well.
Yeah, absolutely. Well, I mean, loved having you on, and definitely a lot of good insights about how people can take advantage of the market and also be cautious about what else is out there. So if people want to get a hold of you, where are some good places where they can reach out or find out more information or invest in some of the deals you're working on?
Yeah, I mean, you can find me on LinkedIn and Facebook, basically under my name of Brian Heller. Right now, if you went to, brianhellerinvestments.com, you can see my current site, which is, like I said, become more of a digital resume. But within the next few weeks here, fairwayequities.com is going to be the best place to find me. And other than that, you can find me on a golf course near Nashville.
Absolutely. I mean, that's who I want to invest with, is the people I can play a good golf game with and, poke all the real estate questions towards. So appreciate what you're doing out there. So there you guys have it. Brian Heller with Fairway Equities. Reach out and do some good investing. Make sure you're doing safe real estate investing deals. And we'll see you again on the next episode here of the Real Estate Investing War Room. Take care.